Jerome, you are in charge of short-term portfolio management at PIMCO. How much more complicated has your job gotten in the last couple of months?
Well, it's gotten complicated over the past 20 years as we've gone through a whole bevy of funding crisis. It's been the past couple of months, admittedly, central bank policy around the world has become more complicated, divergent, in fact. And what we're really preparing for as investors for not only a higher rate environment, which we've seen over the past couple of years, but really more volatility to come. And there's a lot of question marks. As noted in the previous commentary, the front end of the market is really sort of encountering a bipolar world, one where you basically are reconciling the exact of data with potential policies in the government, which haven't necessarily come to fruition yet. And then the longer end of the market's really contending with a longer-term view. Where is growth going to come? What is the impact of government, the G in growth and GDP? And more importantly, where do we think inflation is going to settle in the longer term? And these are things that both the public and the private sector have implications on a go-forward basis.
Why do you think we've seen this constant push on the longer end of the curve? What's your explanation? Because we have a bunch of explanations.
Well, the basic explanation is that you have more supply that's coming in nominal treasuries which need to be issued. And you have an evolving landscape of where that demand to buy those treasuries is going to come from. That isn't necessarily clear in the short term or the longer term. So the rhetoric right now is that you'll have a steepening yield curve where the longer end demands more term premium, more compensation for owning those longer maturities. That's to be determined. And quite honestly, where we need to focus on is in the medium term, where we have risk assets that are priced pretty dearly at this point in time. Recognize the fact that the go-forward process, a second derivative as we get into 2025, of the policy implications and, more importantly, once again, inflation and growth, which the Federal Reserve has been focused on, becomes the dominating factor. So December isn't necessarily a big deal because cash rates will continue to go lower. But as we get into 2025, the volatility or the recalibration of risk appetite will be driven based upon where factors of the consumer and the government see inflation in the medium term.
Do you think we're headed into a bear market, a long-term bear market for bonds?
Not necessarily a long-term bear market, but you may not necessarily have the inverted yield curves or the flat yield curves that we've been used to for so long. And the real question is what is the appropriate compensation for inflation? And for an investor, a fixed income investor, as you think about it, you want to be paid on a real basis, on an inflation-adjusted basis, which simply means if inflation simply moves from 2% to perhaps 2.5% over the longer term, there has to be more compensation. And what we're witnessing is a real-time calibration. Investors should take a step back and just survey the landscape for what it is. It's simply a higher rate environment where volatility because of risk asset pricing may come in the medium term. And think about diversification as that simple approach to reduce that volatility. So think in terms of price-adjusted terms and what price changes can do over that medium term. And investors will be rewarded on the longer term by looking at lower volatility total returns, which puts you into the income generation category.
Steve?
Hey, Joe, I don't know if you want to play this game, but you know the president probably better than, well, a lot of people, pretty better than anybody in this panel. Do you think at some point, Joe, he can step forward and offer some principles about what he thinks about debts and deficits and tax cuts and offset, and that would calm the market? I don't know at 447 if there's a need for him to do that, but I would imagine the market would react very favorably to some kind of sort of fiscal prudent commentary from the president-elect.
Yeah, no, I don't see that. I think you're going to hear mostly, and it maybe not directly from him, but you're going to hear mostly about how deregulation is going to provide the impetus for a strong economy. I don't think suddenly he's going to say, he's suddenly going to say, that no tax on tips. I don't know about that. I'm not sure about those taxes.
But what if he? I'm just musing here, Joe. What if he said that we're going to have an overall principle here, and our principle will be we're going to not blast the deficit, or we're going to try to be neutral on the deficit. We're going to do all these things.
I don't think I've ever heard him mention the deficit.
Neutral way.
I don't think I've ever heard him mention the deficit.
No.
The wild card that I would say is in this whole discussion is growth. And if you have nominal growth increase, then clearly the fiscal side has a recalibration to go. That is to be determined, and what you're seeing in the longer end of the market is not necessarily a question mark, but a natural recalibration in yield terms of trying to assess that risk, if you will. And that makes it more attractive. The Federal Reserve ultimately has a heavy hand if growth diminishes.
Steve, I tell you what, if I don't make any outgoing calls because I'm waiting for the Treasury Secretary appointment to come my way. I haven't really talked about it yet, but I will. If that does happen, I will talk to you. I will talk to the country about the debt. Anything's possible at this point, isn't it? Oh, wait a minute.
I think so, but I think there's a lot of uncertainty, Joe, right? And we don't know how the president-elect feels about these issues. So I know we got to go, but maybe it's a discussion for another time. But I think he could have a pretty profound effect on markets.
Are you up for Fed chair? I put in a good word for you. That's what I'm talking about.
No, definitely not. It would reduce my ability to fish and play music if I was Fed chair. I wouldn't like that.
Exactly.
All right.
It would reduce your ability to play music more than what I've already seen. No, I'm kidding.
You're remembering. Yeah, all right. Steve, Rick, Jerome, thank you guys.